There are posts spreading online right now claiming that if you have $20,000 in a bank account, the government is watching you, flagging you, and preparing to take action against your account. Some of those posts are getting millions of views, and they are generating real fear among seniors, people who spent decades saving, who finally have a nest egg, who are now lying awake wondering if their savings account is going to get them in trouble. Here is the truth. Here is what is actually confirmed, and here is the one real banking rule that does exist, that is not about $20,000, that every senior in this country actually does need to understand before it catches them off guard. Stay with me, because the real rule is both less frightening and more practically important than anything you have seen in those posts. The noise online about $20,000 account flags is largely misinformation. The actual federal banking reporting threshold that is confirmed in law and has been confirmed since 1970 is $10,000 in physical cash. Not total account balance, not electronic transfers, not Social Security direct deposits. Physical cash. Under the Bank Secrecy Act, passed by Congress in 1970 and updated by the USA Patriot Act in 2002, banks are required to file a currency transaction report, known as a CTR, with the Financial Crimes Enforcement Network, which is FinCEN, when a customer deposits or withdraws more than $10,000 in physical cash in a single business day. This rule has not changed in 2026. The threshold has not moved, and it applies to cash, the kind you carry in your wallet or withdraw from a teller, not to the kind of money most seniors receive through direct deposit. That distinction is the most important thing in this entire video. Here is why this matters so deeply for seniors specifically. The $20,000 figure circulating online is not based on a current law or a current rule. It is a distortion of various proposals, rumors, and unrelated banking regulations that have been combined, exaggerated, and shared in ways designed to generate clicks rather than inform. And the people most likely to believe those posts and to act on them in ways that actually create problems are people who are already anxious about their finances, who already distrust large institutions, and who are trying to protect savings they cannot afford to lose. What many people miss is that reacting to a false version of a banking rule can sometimes trigger the real one. For example, a senior who reads that the government is watching large accounts and decides to make a series of smaller cash withdrawals to avoid scrutiny is actually engaging in something called structuring, which is a federal crime under 31 U.S.C. Section 5324, regardless of whether the original money was entirely legitimate. That is the real danger hiding inside the fake news. This applies especially to seniors because many older Americans grew up in a time when you kept cash at home, when banks were distrusted, and when financial privacy felt like a fundamental right. Those instincts are not wrong, they are just being exploited right now by content designed to provoke fear rather than provide useful information. Here's the full picture of what the Bank Secrecy Act actually says. Banks are required to file a CTR when a customer deposits or withdraws more than $10,000 in cash in a single day. Multiple smaller cash transactions on the same day, even across different branches of the same bank, can be grouped together if the bank determines they are made by or on behalf of the same person. This is called aggregation, and it is governed by FinCEN Guidance FIN 2012 G001. Importantly, a CTR is not an accusation. It is not an audit trigger. It is an administrative report that flows into a federal database as part of a monitoring system for money laundering and financial crime. Filing a CTR about your transaction does not mean your account will be frozen, does not mean you will be investigated, and does not mean you did anything wrong. Tens of millions of CTRs are filed every year on behalf of entirely legitimate customers, business owners, retirees, state executors who simply made a large cash transaction. Consider Shirley, a 73-year-old retired county clerk from Savannah, Georgia, who sold a piece of land her late husband had owned for 30 years and received a portion of the proceeds in cash from the buyer, $4,200 in physical bills. When she deposited that money along with a $1,500 additional cash withdrawal she had made earlier the same week, the combined total crossed $10,000 at her bank in a single day. The bank filed a CTR. Shirley received no call, no letter, and no notification that the report had been filed, because banks are not required to tell customers when a CTR is submitted. She only learned about it months later when she mentioned the transaction to her tax preparer. Nothing happened. No investigation. No account freeze. No penalty. The CTR was filed, processed, and moved into a database where it sits among millions of similar reports. Shirley did nothing wrong. She simply made a large cash deposit on the same day as another cash transaction. Her story is important because it shows what a CTR actually is, an administrative event, not a consequence. Now here is where the confirmed 2026 update comes in. And this is the part that is genuinely new and genuinely relevant to seniors. Banks in 2026 are using significantly more sophisticated AI-driven monitoring systems to flag patterns of transactions that may indicate what is called structuring, deliberately breaking up large cash amounts into smaller deposits to avoid the $10,000 reporting threshold. According to reporting by The Motley Fool from January 2026, banks are now using what are called entity resolution tools that can link transactions across multiple branches or even different banks in real time. What this means in practical terms is that if you make a series of cash deposits of $9,000, $8,000, and $7,000 over several weeks, even if each individual deposit is below the reporting threshold, those deposits can now be flagged and reported as a suspicious activity report, or SAR, which carries far more scrutiny than a standard CTR. The upgrade to AI monitoring is confirmed. The risk for seniors who read about the $20,000 myth and respond by making smaller withdrawals to stay under a threshold is now higher than ever. The best protection is understanding the real rule and following it. Here is how the schedule of risk actually breaks down by the type of money most seniors handle. Social Security direct deposits, pension payments, IRS tax refunds, and electronic wire transfers do not trigger currency transaction reports under the Bank Secrecy Act because they are not cash transactions. They are electronic transfers that already have a full digital paper trail. The $10,000 threshold applies specifically to physical currency, bills and coins. Most seniors who receive their income by direct deposit and manage their accounts primarily through checks, debit cards, and electronic transfers will never trigger a CTR in the normal course of their financial lives. This does not apply if you routinely handle large amounts of physical cash, for example, if you run a small business, if you receive rent payments in cash, or if you make a large cash withdrawal for a specific purpose, like a home repair. In those circumstances, understanding the CTR requirement and documenting the legitimate source of your funds is simply good financial practice. This only becomes a legal issue if you deliberately structure transactions to avoid the reporting threshold. The law 31 U.S.C. Section 5324 makes structuring a federal offense regardless of whether the underlying funds are legitimate. The penalty can include fines and in some cases civil asset forfeiture. This does not automatically mean that two deposits in the same week constitute illegal structuring. Intent matters. The law targets deliberate, knowing attempts to evade reporting, not coincidental patterns that happen to fall below a threshold. But given that banks are now using more sophisticated detection tools, the safest approach for any senior handling significant amounts of cash is to make straightforward, transparent transactions, and to keep documentation of where large cash amounts came from, a sale, an estate distribution, a gift from a family member. Some people experience account holds or additional questioning when they make large cash deposits without prior notice to their bank. This does not automatically mean they are under investigation. A brief, documented explanation of the source of funds typically resolves the matter quickly. The most important step right now is to stop making financial decisions based on social media posts about $20,000 account flags, government surveillance of regular bank balances, or any claim that your savings account is about to be seized or reported because of its total balance. None of that is how the Bank Secrecy Act works. Your account balance, whether it is $5,000 or $50,000, is not itself a reporting trigger. The trigger is cash transactions over $10,000 in a single business day. If you have not made any cash transactions of that size recently, you have nothing to do. If you do need to make a large cash transaction, a sale, a distribution, a large withdrawal, the best practice is to keep a record of why. Write down the source of the funds, keep the relevant receipts or documentation, and if the amount is close to or exceeds $10,000, simply be prepared for the bank to file a CTR. It is a routine administrative step. It is not a consequence. You do not need to hire a lawyer before making a large deposit. You do not need to call your bank in advance to ask permission. You do not need to break up deposits into smaller amounts. In fact, doing so is precisely what you should not do, because it is the behavior the monitoring systems are specifically designed to detect. Be cautious of any website, video, or person claiming that they have a strategy for keeping your money away from government monitoring systems. Those strategies almost always describe illegal structuring dressed up in language designed to sound like financial advice. The only strategy you need is straightforward, documented financial activity, and an understanding of the one real threshold that actually applies to you. Here's what we know for sure. The Bank Secrecy Act, in force since 1970, requires banks to file a currency transaction report when a customer deposits or withdraws more than $10,000 in physical cash in a single business day. This threshold has not changed in 2026. Banks in 2026 are using more sophisticated AI monitoring to detect patterns of transactions that may indicate deliberate structuring to avoid the reporting threshold. A CTR is an administrative report, not an accusation, not an audit trigger, and not a consequence. Deliberately breaking up large cash amounts into smaller deposits to avoid the threshold, structuring is a federal offense under 31 U.S.C. Section 5324, regardless of whether the underlying funds are legitimate. Social Security deposits, pension payments, and electronic transfers do not trigger CTR requirements. Here is what is not confirmed and not true. There is no confirmed 2026 rule, law, or regulatory change that flags bank accounts simply for having a balance of $20,000 or any other specific amount. The posts circulating online about $20,000 account surveillance are not based on current federal law. The $600 threshold that generated concern in prior years for payment apps was addressed by the One Big Beautiful Bill Act, which raised the reporting threshold for Form 1099-K and related forms to $2,000, reducing the paperwork burden for most small transactions. not increasing surveillance. There is no current federal mandate to report ordinary savings balances to any government agency simply because of their size. Staying informed protects you. The seniors who are most at risk right now are not the ones with large savings accounts. They are the ones who read a scary post, panic, and make a series of small cash withdrawals trying to stay under a threshold that does not apply to their situation in the first place. You now know what the real rule is, what it actually covers, and what behavior to avoid. If this video helped you separate fact from fear, please share it with someone in your life who has seen those posts and is worried. Leave a comment below and tell us your state or your question. Every comment is read. Subscribe so you do not miss the next update, because financial misinformation targeting seniors is not slowing down in 2026, and staying ahead of it is the most effective protection you have.